Welcome back to the channel. Today, we're diving deep into a topic that often comes up in discussions about personal finance: personal loans versus lines of credit. Both options can be valuable tools in your financial toolkit, but they each come with unique characteristics that make them suitable for different situations. As we explore these two financing options, I encourage you to reflect on your own financial needs and goals. Let's begin by looking at liquidity. Personal loans typically provide a lump sum of cash upfront, which means that you receive all the funds you need at once. This can be particularly beneficial if you have a specific project in mind, such as home renovations or consolidating high-interest debt. Once you have the money, you can use it as needed without worrying about borrowing again until the loan is paid off. In contrast, a line of credit functions more like a revolving door. You have access to a certain amount of funds, but you only withdraw what you need when you need it. This flexibility can be advantageous for ongoing expenses, such as managing cash flow in a business or handling unexpected expenses that may arise. With a line of credit, you're not limited to a single disbursement. Instead, you can borrow, repay, and borrow again as long as you're within your credit limit. Now, let's consider accessibility. Personal loans often require an application process that includes a credit check and possibly documentation of income and financial history. Lenders want to ensure you're capable of repaying the loan before approving your request. This means that for those with less than stellar credit scores or who are self-employed, obtaining a personal loan might present some challenges. On the other hand, lines of credit can sometimes be more accessible because they often leverage existing assets as collateral. For instance, if you're applying for a home equity line of credit, HELOC, your home serves as security for the loan. This could mean lower interest rates compared to personal loans and potentially easier approval processes. However, keep in mind that using collateral comes with its own risks. If you default on the line of credit, you may risk losing your asset. Next up is profitability. When considering how each option fits into your overall financial strategy, think about interest rates and repayment terms. Personal loans usually come with fixed interest rates and set repayment schedules. This can help with budgeting because you'll know exactly how much you owe each month until the debt is settled. However, if you're not careful with how much you borrow or if your financial situation changes unexpectedly, it could lead to larger payments than anticipated. Lines of credit typically come with variable interest rates, meaning they can fluctuate over time based on market conditions. While this might result in lower initial rates compared to personal loans, there's an element of uncertainty involved since your payments could increase if interest rates rise. This requires careful monitoring and management on your part to avoid falling into a trap where payments become unaffordable. Then we have risk. Personal loans usually carry predictable risks. Once you've borrowed the money and agreed on the terms, you're committed to repaying it regardless of your financial circumstances later on. If something unexpected occurs, a job loss or medical emergency, you may struggle to make those fixed payments. Conversely, lines of credit involve their own type of risk. The temptation to overextend yourself is significant. Because funds are easily accessible for ongoing use, some individuals find it challenging to control their spending habits. This could lead to accruing more debt than planned or getting caught in a cycle of borrowing and repayment that feels never-ending. Lastly, let's touch on psychological factors. With a personal loan, there's often a sense of finality. Once the money is received and spent towards its intended purpose, it's clear what you've done with those funds and how much remains to pay off. However, lines of credit can evoke feelings of security mixed with anxiety. While having access to funds can feel empowering during emergencies, it might also lead to worry over potential debt accumulation. In conclusion, both personal loans and lines of credit offer unique advantages and disadvantages, depending on your specific situation and mindset regarding debt management. The best choice really hinges on your financial goals, whether you're looking for stability and predictability with fixed repayments or flexibility with ongoing access to funds. I'd love to hear from you. Have you ever used either option? What were your experiences? Which one do you believe suits your financial journey better? Drop your thoughts in the comments below. Let's get a conversation going. And if you found this comparison helpful, don't forget to like this video and subscribe for more insights into navigating your financial future. Thank you for watching.